You've done the work, a fresh A-plus zone, in the direction of the higher time frame. Now you actually have to enter, and this is where a lot of people freeze up. Let's make it mechanical. The 2 ways to get in, how to place your stop so a normal wick doesn't take you out, and where to aim. No guessing. There are 2 ways to enter a zone. The aggressive way. Place a limit order right at the proximal edge and let price come to you. Best price, but no confirmation, so more of them fail. The safer way, wait for price to reach the zone, then drop to a lower time frame and enter only when you see a reaction, a small shift in structure that says buyers or sellers actually showed up. You give up a little price for a lot more confidence. Neither is wrong. Pick the one that fits your temperament. Now the stop, and this is non-negotiable. It goes just beyond the distal line, the far edge of the zone. Not in the middle of the zone, not at the proximal edge. Price is supposed to poke into the zone. That's the entry. You only want to be wrong if price closes clean through the far edge, because at that point the zone has genuinely failed. Give the trade the room the zone defines, and no more. Where do you aim? The cleanest target is the opposite zone, the next area where price is likely to run out of steam. Bought from a demand zone. Target the supply zone above it. Sold from supply? Target the demand below. Because your stop is small, just the width of a tight base. Even a normal move to the opposite zone can be 4 or 5 times your risk. That asymmetry, a small stop and a distant target, is the entire financial case for trading zones. Prop challenge, or leveling up your own trading. Signal Deck tracks every trade in R with quant-level analytics. Prove your edge. Free. Link in the description. One more piece, managing it once you're in. As price moves away from your zone and structure shifts in your favor, slide your stop to break even. Now the trade can't hurt you. Many traders take partial profit at obvious levels along the way and let the rest run toward the opposite zone. Exactly how you scale is personal, but the principle is constant. Protect the position first, then give the winner room to reach target. Manage the trade, don't babysit it. Recap. Enter at the proximal edge, either with a limit or after lower time frame confirmation. Put the stop just beyond the distal line and target the opposite zone. A tight base turns that into a big reward-to-risk trade. Then manage to break even and let it work. Next episode, we put the entire series together, taking one A-plus trade from a blank chart to a closed position. Subscribe, the capstone is a good one.